Welcome back to the CPA Revolution. I'm Charina Padilla here with our tax strategy expert and co-host, certified tax coach and CPA Jose Ortiz. If you are tired of traditional reactive CPA advice and want to turn taxes into a wealth building tool, you are in the right place. Hi, Jose. Good morning. Here we are halfway through October, finishing up tax deadlines, and it's also birthday week for you. How are you feeling?
Great. It feels really good because right after the October 15th deadline, my birthday, it's like almost natural, right? So I get to kind of unwind after that. But yeah, we're getting there in the fourth quarter of the year and starting to get the people rolling in with their capital gains, the real estate investors kind of worried about what they should be doing. I'm sure you're starting to get that stuff too, right? With those cost segregations at the end of the year.
For sure. Yeah, there's a lot of plans that are coming into place as far as like planning to make sure they're set up for a great 2026 tax season. So, yeah, same story here. We're looking at all the opportunities, all the items that could be, addressed now and put those action plans in place to make sure that they are doing what they have to do before the December 31st comes. Because, once the first comes of the year, that's it's too late, right? You want to take care of things before December 31st to determine how much profit you're going to be able to keep.
Do you guys get a lot of calls on like December 31st like I do?
We do. We do. So usually it's not holiday season, it's tax planning season for us.
That's right. That's right. The interesting thing this year is that we have the 100% bonus depreciation that's come back, right? So, and that's actually permanent now. So we're going to have a lot of fun with this until it's not permanent anymore. But every single year, we can kind of start utilizing this for strategy. So definitely want to talk about a few things that you guys can do as real estate investors to mitigate capital gains. All right. Now we are in the fourth quarter. We're in the fourth quarter. So a lot of the things that I'm going to tell you now, you got to probably move like yesterday, or it might be kind of borderline late, right? Because like I said, it's October.
So Jose, talking about deferral strategies for the end of the year, I see here on your list for your next article that you want to dive into Section 1031, right? Or the 1031 exchanges. That's one of the classic items. Can you walk us through what it does and how the timing is so important for us to take advantage of these deferral strategy?
Absolutely. So basically what happens with 1031, you're a real estate investor. You're thinking about getting rid of one of your properties. Maybe you want to kind of move from, just to say, a single door to a multi-door opportunity, right? So basically, I want to do that. I don't want to have to sell and then pay capital gains, right? Doesn't make sense. So basically, 1031 exists to be able to assist your investors with this. So what happens? I sell a property, and basically what I'm doing is, in the IRS's eyes, I'm basically exchanging one property for another. It has to be of something equal or greater value, all right? So what qualifies? Property held for investment, right? Or used in a trade or business. What doesn't qualify, like I kind of mentioned earlier, is your primary home, your short-term flips, right? Things like that, or property held for resale, right? So you might be like,
and I get this question all the time. It's like, oh, can I do that with my primary residence? And that's no, it needs to be an investment property that it's getting exchanged for a like kind property of equal or higher value, right?
Exactly.
And a lot of the investors and homeowners that do want to take advantage of this section, they don't know that they could technically turn their primary residence into a rental and wait a period of time, right?
Yep.
And then they can, and then they can do the 1031 exchange. So there are situations, and that's why it's so important for you to work with a strategic CPA to make sure that there is a roadmap in place to understand what you can and cannot do, right?
Exactly.
So
I'm glad you mentioned that. Yeah.
I would love to hear from you, like what are some of the things that we
Yeah.
should be taking into consideration and which ones we should avoid, right?
Yeah, you mentioned things like strategy, and I always talk about stacking strategies, right? So something like a 1031, and we're going to kind of get into the rules and how it works in a second, but if you can imagine this, I want to get into real estate, right? Maybe I don't have a ton of funds right now, but I can buy a property. What if we were to do a house hack where we buy a multi-unit property, maybe a duplex, live there for 2 out of the next 5 years, and then guess what? I could basically do a 1031, move that into, say, a bigger property, and I start building my empire. And that's how a lot of people do it, right? You start small, and you start using all of these tools. So like if I were to get rid of that duplex and I do a 1031, then basically I can go in and then I call Charina, I need a cost segregation, right? And then I start saving from there, right? So a lot of things that you guys can do are stackable. So if, like you said, you have to kind of talk to somebody who can help you lay out your vision.
Right.
See what you got, see where you're starting from, and see what we can do to start kind of planning that. And, we do, for my clients, we'll do 2 5-year plans, whatever it may be, just to kind of get things going. And I'll tell you, it helps when you have a vision. It helps when you have a vision because things start becoming a lot clearer to you.
Right.
So,
and we want to turn those visions into actions, right? So it's not just a
exactly.
vision, we want to add the actions to it.
Yep.
And for someone that's just interested in getting into real estate, what would be kind of like the advice of where they should get started, Jose?
Yeah, it's all different, right? It depends on where you are, depends on your knowledge in real estate. I wouldn't tell anybody to get into things that they don't understand just by looking at YouTube or whatnot. So you really have to work with somebody who can sit down and listen to what you're saying and then kind of translate that into, okay, what would that look like? What are the possibilities? How can we get you into your first real estate investment?
Mm-hmm.
Not how can we? So those are the things that I normally do. So the answer to that question is it depends. And that's a CPA's favorite answer. I get that. But it really is one of those kind of things where it depends who I'm sitting across. It depends on the situation that you guys are currently in. So how does a standard 1031 work? Well, you obviously want to list and sell your property, right? So you want to list and sell the old property, but before you close, you want to hire something called a qualified intermediary, right? They're a neutral third party that basically holds the sale proceeds, right? And what does that mean? You can't touch the cash. And I've had people who have kind of like got into this after the fact. They've taken a profit or they've taken some of that cash out, and you can't do that. So basically, you want to give it to the QI, right? That tells the IRS, hey, I'm not out there blasting through that money or whatnot, right? I'm out here, I did things the right way. So it's the QA, not the QI. Now I want to close the sale. Right. So where do the proceeds go? Again, to the QI, not to my account. Then we have 45 days. So now you can understand why I say we're getting really close, right? We're really getting close. So we have 45 days to find a replacement property, right? And of course, we have to make sure that it's of equal or greater value. And we want to make sure we identify three properties always. All right. So because that's what they allow you to list, up to 3 replacement properties. Now, I've identified those properties. Now I want to choose one to close on. And I need to close on that property within 180 days of the sale, right? Of the sale.
Of the original property, the relinquished
exactly,
one. Right.
Exactly. So then after that, we basically buy the equal or greater value property. And we want to make sure, and I want to kind of bring this concept up, but I just want to make clear and make it very clear for you guys what this means. We do this process because we want to avoid boot. So basically, boot means, it's not boot like, the ones you guys buy at the stores. It basically means that anything that you receive from the sale that isn't of like kind real estate, meaning any additional money that I get, right, from a sale that was not of something equal or greater value, right? So what happens with boot? Well, they tax you on it. So we want to be able to avoid that. So really this works because from the IRS perspective, we're not buying or selling, we're just swapping the property out. So a lot of people, Charina, will do this 1031 till they die, 1031 until they die. Because what happens is they keep building up their property base. When they pass, and if they put it into an estate and all that stuff, which you should do, it gets a markup, the fair market value. If you pass this over to your next of kin or whoever, your children, they don't pay cap gains on it because, right, the IRS basically recognizes that the gain is transferred on the sale. So basically, you get no tax on that for your next of kin, from your estate. So this is really, really good for someone who kind of maybe not understanding real estate so much in the beginning, but kind of wants to learn, start small, work their way up, build that base, and then have it part of their estate.
And the most important things that I got from this conversation, Jose, is that the timing is so important. You have that 45-day identification period, right? It's so important. You need to select 3 properties, right, to be able to relinquish your old asset. And then you have 180 days to close, right?
Yep.
And as usual, my shameless plugs, we are the only company offering free 1031 exchanges. Normally, and this is something that I want to add in here because it's of value, the qualified intermediaries, they make their money on the carry while that money's sitting in escrow, right? So the way that we've been able to disrupt the industry is that we're providing the initial fee, it's eliminated, it's for free. And then we're also giving you a percentage of the carry interest that it's produced while your money's in escrow.
Wow.
So if you need a 1031 exchange, make sure to reach out to me and I'll be happy to get your process started.
Yeah, we'll have the link in the chat for our article, so make sure you look out for that. But I mean, where the heck are you going to find a free 1031? I mean, that's unbelievable. That's great. So make sure you talk to Charina if you're definitely thinking about that, because this is really a good way to go. And what makes Charina and her team very kind of unique is that they do this all the time. They understand real estate, right? So they understand what the scenarios may be that you guys are confronting.
Yeah,
All right.
would love to help them. So Jose, I know for the more advanced investors that have already been taking advantage of 1031 exchanges, there's also another level that's unlocked, right? Which is the
Yes.
Delaware Statutory Trusts. So
Correct.
how can experienced investors be aware and consider this as part of like their deferral strategy for the end of the year?
Right. So let's just say I don't want to continue buying properties, or maybe I want to be hands off, right?
Yeah,
This is
the
where
management. Yeah, you
yeah,
don't
'cause
want.
it gets hairy. I mean, you got to spend some time doing this. It's a business. So there's something called a Delaware Statutory Trust, and basically it is what it sounds like. It's a trust, right, that owns a large institutional grade real estate. Basically, what you can do is you can buy a fractional interest in that trust, right? And the IRS treats that as real property still, so same thing, right? For 1031 purposes, I should say. And basically what happens is you just roll that puppy, your capital gains, into that DST, that Delaware Statutory Trust. DSTs are like fast, easy to do, and they work kind of like as a 45-day backup identification if your preferred deal falls through. So you should always have kind of like that backup, right? Backup plan.
Right.
So the plan and the backup to the plan. Because
Right.
if you can't get that done, especially like you're in a time crunch like right now, it could be an option. Of course, what are the cons? Well, you don't have that money to play with, but you're not paying capital gains either, right? So it all depends. Again, it goes back to what is your motive? What's your motivation? And then we go from there.
So I think that the ideal investors for a strategy like this would be someone that is already tired of being a landlord, right? Or maybe they're
Yeah.
getting to retirement age and they really don't want to deal with all the back and forth. So now they have acquired a set number of properties and they do have a lot of equity in there. They know they're going to get hit with that capital gain tax. So
Yep.
there's still light at the end of the tunnel where you could just convert that and still continue to be a passive investor, right?
That's right.
And get the benefits of real estate and
Exactly.
get dividends, right? So it's very good option for you to consider and have it as part of like your playbook, right? To see,
Exactly.
depending on how things are performing. Maybe you don't want to do all the properties, maybe you want to do a percentage of them. So it's always good to diversify, in my opinion.
Exactly. So, it's one of those things where it all depends on where you are in your journey. But if this sounds like something that you might want to, where it's piquing your interest, reach out to us. Let us know, because we definitely know plenty of qualified DST sponsors.
Beautiful. And this takes us to the next strategy, Jose. Section 453, the installment sale.
Yeah.
Please explain why this is such a good option for many investors these days.
Yeah. So let's suppose in someone's scenario, they want to sell their property. They don't want to do it. Again, maybe you're not interested in 1031. Maybe you're kind of like phasing out of the real estate investment game. Well, I don't want to pay. Let's just say you have a property that has a ton of equity. If I were to sell that property, I'm going to get hit. Okay. So what are one of the options? Well, there's something called, and you said it, Section 453, an installment sale. What does that mean? Exactly what I'm saying, right? So Charina, I sell you my property. I have a $500,000 gain on that. I'm going to get clobbered. I'm in maybe the 20% bracket for capital gains. I don't want to pay that, right? So basically what I do with you, Charina, is like say, hey, listen, let's do an installment sale, right? Where you pay me over a set period of time. And basically, when do I actually recognize the gain? The year of the installment sale, right? So basically, it helps you from a cash management standpoint, because you're not paying a ton of tax either. But it also helps us from a tax planning perspective, because the best thing that you could ever give me as a tax strategist is time, right? Time. And so we can plan around those installments every single period, right? So that you're fighting that off at the same time, right? And you face minimal capital gains, right? So that's what we like to do.
And I get this question asked all the time. It's like, oh, well, I sold this property. What can I do now? And it's like, no, it's timing. It's so important. These type
Right.
of structures need to be set up before closing. So even before you get into a purchase agreement, make sure that you have a plan in place on how you're going to mitigate that capital gain.
Yeah, and the challenge with this, as far from a timing perspective, imagine I have to find, well, I'm selling my property, so finding buyers, it depends on the market, hot, cold markets, whatever. But then also I have to kind of find someone who's willing to, right, pay in installments. Sounds
Mhm.
good for a lot of people. Some people don't want to do that. They just want to just pay it out. So, it adds to the complexity, to the challenge of getting this done. So again, you want to do this, right, earlier in the year, not towards the end of the year. Ideally you want to get this done as fast as you can so that you can avoid those capital gains.
Yeah, be proactive.
Be
What are
proactive.
some of the things that we should avoid, Jose?
Well, you're gonna have to look for. It's always comes down to the states. Do they conform to the IRS rules, right? So you always want to make sure. And then you also have to think about depreciation recapture and all those kind of things, right? So those all come into play, but that comes into play when we're dealing with real estate, right? So those are kind of like the standard rules. So again, making sure that the contract is airtight, right? That there is an agreement there that mentions the installments and so forth. But those are just kind of the things that are, par for the course, if you will.
Yeah, I've heard like under the IRS, point of view, there's a lot of a scrutiny around the deferred sales trust, right? Have you heard
Yeah,
anything about that? So I think like that's one of the things that we should educate the audience to look out for, right? So
yeah,
yes,
yeah.
you could take advantage of Section 453, but then always kind of like be on the lookout and do your research and make sure that you are working with a reputable team that's going to be able to have your best interest in their mind.
Yeah, and part of that comes with, like, okay, so you heard about deferred sales trust maybe on a YouTube video or whatever. You have to be able to take that back to somebody and ask them, a CPA, somebody who is understanding these things, to see if it's a viable strategy for you, because a lot of these things can be kind of schemy, you know what I'm saying? And like, in my instances, my clients will bring up some things to me, and I'll do the due diligence from their perspective, to make sure that there's something that I can tell them, hey, it could be something that you can look into. DST is not one of those things, because currently they're under IRS scrutiny. So I would tell you, stay away until there's some clarification on that from the IRS.
Beautiful, beautiful.
Yeah.
All right. So there's a lot to unpack on this episode, but I don't want to like stop until
Yeah.
we get into a few other ones. So I know this is something that a lot of my clients have used for many years, which is the lazy 1031 exchange.
Yeah.
So this is beautiful because instead of going through that 45-day identification period and the 180-day and identifying 3 properties, the key to this is to make sure that you are selling the property that you are relinquishing, right? And then buying a new one within the
Right.
same tax year. So I would love to hear your take on this, Jose, and how you've been able to take advantage of this strategy for your
I
clients.
love it. I love it because, people, when the 1031, what the people that I talk to about that usually see first is the complexity. Oh, I got to make
Mhm.
sure I do this. And I don't know. So I tell them, is, listen, if they're like kind of on the fence about selling, they've been thinking about it for some time, but they, and they want to kind of move into something different, but they don't want to do a 1031. They can't do the 1031. Then I'll tell them, hey, we're here in October. Can you wait 3 months? Can you? I mean, if you're thinking about kind of selling in the next 6 months, right? Can you wait that 6 months? Because here's the thing. What if we were to revisit the sale of that property in January, sell that property in the first quarter of the year, use the second quarter of the year to locate a property. Third quarter of the year, I'm your CPA. I call Charina. I say, hey, we just found another property. We're going to close on it. My client wants a cost segregation, 100%. Again, right?
Bonus depreciation, yeah.
Exactly. And then when you work with someone who's qualified, they can basically say, hey, Charina tells me that we should be able to get back more or less this amount of money. How much capital gains that we have from that sale? Does it match? Or is it
Mhm.
close? What does that do? Well, the losses that you get in that first year offset the gains from the sale. It's a beautiful thing. And there's nothing lazy about it, by the way. It's just
Right.
one of those things. To the contrary, it's actually still work. But you don't have the stress of the 45 days, the 180 days, all that kind of stuff. And for people that matters, right? They kind of want to see it through without having to rush through the process. So
Right. That those
yeah.
time constraints sometimes,
Mhm.
alleviate other things. We don't want to be stressing out, but as I always say, it's good to have options, right? And we want to
Yeah.
empower you to have that information readily available so you can make the best decisions for you.
Exactly. And my annual clients, that's what they'll do. They'll call. They say, hey, this is what, or we'll do our little quarterly meetings and say to me, hey, this is what I'm thinking about doing. And then I'll say, hey, okay, that sounds great. Let's do this. I'll have my people give you an estimate of, basically that property that you're looking at, and we can strategize and see it through, right? But of course, you need somebody to talk to and somebody to help you think through these things, because obviously we don't know everything, right?
Yeah.
You want that team.
For sure. And speaking of teams, we had a great guest on our episode last week that talked a little bit about qualified opportunity funds, right?
Yeah.
And this is also a great strategy. So I'd like to invite people to kind of like check that article and that recording as well.
Yeah.
But here we are talking very briefly again, Jose, what should clients be looking at if they're looking to defer taxes before the end of the year? We have 70 days left, literally. So time is of the essence.
Well, you need to find a strategic CPA. There's no more time. There's no more time in the year. So you need to find them. And then you need to have somebody who's experienced and can give you the different options based on what your situation is. The QOZ, I like the QOZ. Jason did a great job last week of explaining it. Again, like you mentioned, go ahead and check it out in our previous episodes. But the thing is, it gives you 180 days to find a property. Okay. Again, it's going to lock your cash in. You have to understand that. And some people don't want that. Fine. But if you want to, you have to give up something for something else, right? So if I don't want to pay capital gains, QOZ is a great option if I'm willing to put in the money and just sit on that. And again, it has its own benefits, right? You can basically, fight off a lot of tax with it, but is it right for you? So we want to make sure that you kind of consider that. So we look at all of these different options. By the way, I just covered some of them. I mean, this is a short show. We could be here all day, but there are different options, right? And
Yeah.
you have to have that. You have to have that person on your team. It's costing you if you don't, and it will cost you. So
For sure.
Yep.
Well, we are truth speakers here, and we want to make sure that this information is readily available for everyone. And
Correct.
it is up to you to be proactive, to do your research, to build your A team, and make sure that you are putting these options into place to be able to pull them whenever they're needed, right?
What do we got next week? I think we have Mr. Michael Sims, our man, Michael Sims. Michael is going to be talking about something called LEOs. It's an interesting strategy. I have done my due diligence, and actually we've worked together on a few of these. The reason why I'm bringing this LEOs strategy now is because this is kind of one of those last minute things. When people call me on December 31st, guess who I call? I call Mike, right? Yeah. So
he can definitely work quick and efficiently, and we love any and everything that works on deferring taxes. I want to make sure that everyone understands that deferring taxes is not a loophole. It's a timing play. It's a timing play. Every strategy that we've covered today, and the ones that we've covered in the past, and the ones that are coming for the future, they're here, they're available for your use. You just have to understand where you are now, right? And where you want to go. That way we can customize a plan that's right for you. So I think we've said it numerous times, Jose, here, you're working with an average CPA, they're gonna tell you what's happened in the past. And then strategic CPAs are obviously going to tell you what you can still do. Sure. So before the year end, map your sell date, check your timelines, make sure you pick your play, because the difference between filing and forecasting is just theoretical, right? It's 5 to 6 figures of real money. And who doesn't like money?
I know. And the thing about it too is my clients, I like to tell them, most people are thinking about 2025. You're already thinking about 2026.
Yep.
So,
So
all right, guys. Well, thank you again. It's always great kind of sharing these thoughts with you, Charina, and helping contribute to the public education. So looking forward to next week.
thank you. Have a great day.